So we started coverage of Central America and the Caribbean early this year with 8 countries, the main countries in Central America and the Dominican Republic, Jamaica, and Trinidad and Tobago in the Caribbean. We do full economic databases, country reports, investor calls, and also we will do client trips to the region. That covers about 85% of regional output. This has been, I think, a very timely project because when we look at the macro picture, policies, and also financial market development, it's pretty clear that the region has made significant progress in recent years. And just 3 things to illustrate this point. On the macro front, despite the global headwinds and a slowdown in the second quarter, growth has been relatively strong in the context of contained inflation. Second, on policies, we have seen significant improvements, and I think the best example is monetary policy frameworks. Inflation targeting regimes in the region are much more credible, and that has allowed for significant monetary policy easing this year. And also, even though I would say that fear of floating is still high in the region, for some more exchange rate flexibility. And finally, financial market infrastructure has improved, ranging from operational to governance and institutional aspects. So markets in the region are deeper and more in line with what we see in other emerging markets. Of course, there are many challenges and risks, and we will talk about that. But I think the overall picture is, and the story is quite compelling. And this new landscape for the region provides opportunities for banks and investors, which I think is very good news. The other piece of good news is that we have here a high caliber panel of experts in the regions that will share their views. So feel free to use the app, the IIF Conferences app to send questions. So I'm going to start with a question for the whole panel. And let's start with a broad issue, and then we can discuss more country-specific cases. I mean, in terms of risk and challenges, the structural challenges in the region have been long discussed, but there are issues affecting growth in the short term. So I would like to ask, what are the main risks to the growth outlook, particularly for 2020? So let's go by alphabetical order. So JD, please, the floor is yours.
Thank you, Martin, for the invitation, and to the IIF as well. I think we might all sound redundant, but I think the first risk for the region is trade. We all know that the region is quite tied to the United States, and if there is a slowdown, the region might suffer. The second question that could be also a double whammy is what's going to happen with commodity prices. We know that many of these countries are sensitive to commodity exports, both in terms of volumes and value.
Thank you. Thank you very much. Patrick?
Sure. In terms of risk, I think for the broader region, I see the main risk as just general relationship with the U.S., which I think can't be understated in terms of just impact of U.S. administration policy, this one and subsequent administrations, and just U.S. business investment in the region. And I think improving ties and just making sure ties with the U.S. are strong from the administration perspective and business community is very, very important. In terms of migrant flows, remittances, U.S. investment, U.S. aid, just relationship with multilaterals driven by the U.S. I think that's an important thing to watch.
Thanks.
So thank you, Martin, and thank you, colleagues. I'm also the mission chief for El Salvador, so it's easier for me if I zoom in on the country.
Yeah, that's great.
And
yeah.
this was a nice segue coming. I think the main risks are always external for El Salvador because they have very tight link with the U.S. So for them, the growth risks are related to if the global slowdown, and especially in the U.S., is going to be more than expected and faster than expected. And also from the domestic front will be if the budget will not be approved with the priorities of the president, and most importantly, if there are going to be policy slippages and more spending for which they do not find adequate funding.
Thanks. Marcelo?
Martin, I think this is like a game of cards, meaning that in the short run is great if you have a good hand of cards. In the long run, however, what really matters is how you play your hand. So when I think about risks for the region this year, the cards they are given are coming from the global picture, which is quite challenging. I mean, global growth is clearly slowing down, particularly in the US, where the debate's about recession. It affects trade, it affects remittances to the region, it affects tourism, which is relevant for the Caribbean. However, more importantly, I think that this challenging environment is how the policymakers in the region deal with that. And I think three key challenges domestically, to keep it short, are the following. First, you have to address the issue of the drug-related crime and violence, and what it means for migration in particular. Second challenge, I think, domestically, has to do with finding conditions to support growth, and not just any kind of growth, has to be inclusive growth to tackle the issue of poverty and make sure you have a welfare security net, a safety net in the region. And third, not less important, you have to find the conditions to improve resilience of the region to shocks. The region is very exposed to commodities, to climate-related shocks, and you have to diversify away from those shocks to improve your resilience. So to make a long story short, I mean, in the short run, it's great if you can have good luck, but in the long run, what really matters is good policies.
Thanks. And we will talk definitely more about that. Juan Pablo, welcome.
Thank you, Martin, and to IIF for the invitation. I would start by saying that in addition to the usual short-term risks to growth, I think that Central America is at this moment living very interesting times in the sense that there are many things going on that will shape the future, not only for the economy, but for those societies as a whole. I would say first that a challenge in this new scenario will be managing the relationship with the US and China at the same time, because China is an emerging player in the region, which is very active with several key countries. So at a time when these two superpowers are clashing, managing those relationships simultaneously can be very, very hard, but if it's properly managed, the potential for the region is very important. Second, redefining migration with the US. As you may well know, that's a very important aspect for Trump administration, and at this moment several countries in Central America have been playing an active role in trying to contain the flow of people going to the US, which in economic terms means making sure that these people has opportunities in their home country. So that's going to be also very important. Third, consolidating new political leaderships. For example, in El Salvador, you have the new president, Nayib Bukele, who is a very popular person. He is a very active social media user, and people really like the way in which he communicates, but also this new leadership needs a much clearer agenda in terms of economic action. And finally, I would say that consolidating public and private partnerships will be key to promoting infrastructure development in the region, which is a very important barrier for higher growth.
Thank you. Since El Salvador has been mentioned, maybe that's a good way to start. There are the country cases. And there, the new administration has differentiated itself from the different, from previous administration. There is different in so many ways. But when we look at fiscal policy, the government has just presented the budget, And we don't see many changes compared to previous administration. Also, actually, the finance minister, Nelson Fuentes, comes from the previous administration. And it seems also that in El Salvador, there is not a lot of scope to introduce radical policy changes. So, Alina, maybe you can mention what you think would be the main economic policy changes that we should expect from the Bukele administration?
Yes, thank you very much. So the Bukele administration has talked about the most important things to to create the conditions to attract the private investment to support growth and therefore create employment opportunities so that they can stave off migration. So they said that, and how does the 2020 draft budget looks like then? Then the main priorities and where you can see increases in spending, you will see increases in security, increases in spending for education, and increases in public capital spending for provision for infrastructure. So what they are doing right now, from what I could see from the draft budget, is to create the conditions to deliver the public goods that will lay out the foundations for the private sector growth. But in terms of the overall budget, as you mentioned, it's not a big change in fiscal policy. The primary fiscal balance, it only improves by 0.2% of GDP. And that is because they have a high level of debt, about 70% of GDP, and therefore they don't have much fiscal space. So they're always gonna have to balance how much they're gonna support the economy and how much they're gonna try to do fiscal sustainability, fiscal consolidation in that particular year.
What do you think would be the growth implications? Because growth has been very low historically and also compared to other countries in the region. So when do you think we could see an impact on growth?
So it's very interesting because it happens exactly at this juncture in which you have a synchronized global slowdown, yet you have the country-specific factor in which the president is trying to stimulate the economy and attract private investment. So we are in the process to try to figure out this assessment. The draft 2020 budget also shows how much new private investment they were able to attract. So you will see the figure, the minister is talking about it. Now what we are interested in is how much was in the pipeline before, because we know that they approved a lot of construction permits. So you will see going on in the Q3 and Q4. But for example, for next year, what we are interested to see is if all these commitments from private sector, domestic or from abroad, will actually materialize, and when and how.
Thank you. Juan Pablo, the Bancolombia has important presence in El Salvador and also in Panama, so the two fully dollarized economies in the region. In both countries, we have new administrations with just only a few months in power. And in Panama, actually, the government has inherited a worse than expected fiscal position. They have called for a relaxation in the fiscal responsibility law. So what do you think are the main features, are going to be the main features of policies in both, fiscal policy in particular in both countries?
Yeah, I will start first by saying that, as Alina mentioned a few moments ago, the problems in terms of fiscal, especially the high burden of debt in El Salvador, are structural in nature. And in that sense, fiscal consolidation is essential for making sure that the macroeconomic foundations of the country are sound going forward. But at the same time, the government is committed to improve security in the country, and that has had, of course, an additional cost in terms of spending towards police and military personnel in this new plan to address violence. So far, it has been very successful, but it will require much more effort, not only in terms of security, but also giving population economic alternatives to reduce crime. So what I think is that in terms of growth, El Salvador, we maybe need to mix the need to spend more on security with maybe the expectation that other sectors such as retail, manufacturing, and also tourism under better security conditions can grow more and in that sense compensate for and get a higher growth. In the case of Panama, what I think is that this new administration has found a very complex fiscal scenario. In the first half of the year, total GDP was around 3.3%. Total fiscal deficit was 3.3% of GDP, when the target, according to the fiscal responsibility law, is 2%. So it's very likely that the target will be amended, which is commonplace in Panama. But most importantly, the new government had to implement and to present to Congress a very austere budget. It is the first time in 30 years that total spending in Panama will be less compared to this year's total number, which of course is a challenge for the current situation in terms of growth. Let's remember that Panama is growing at this moment around 3%, which is a very low figure for this country, and it is actually very unlikely to expect that fiscal stimulus will help the economy to move towards a higher rate of growth. I think that the private sector will be the main responsible for getting more growth, and I think that's possible, especially when you take into consideration that mining sector will be very important with copper and gold production as a new sector for Panama to develop.
Thank you. Patrick, when you look at spreads, I mean, El Salvador is at the top of the list, but also is Costa Rica. So how fiscal policy in both countries compare?
Sure, and I don't want to add too much more to El Salvador, but from how we look at things in El Salvador, I mean, yes, debt to GDP is pretty high, but you have to remember that includes pensions, which is not apples to apples how most people compare debt to GDP in other countries. So, that's one point. The fiscal deficit is there, it's persistent. I think the authorities are trying to do the right thing, slowly but surely. I think the biggest issue, as we talked about, is just the growth problem, and I think we're pretty optimistic that maybe in the short term, but over the medium term, that the Bukele administration is going to get growth going again. Not 5-6%, but even a 1% pickup would do wonders to the fiscal situation there. So we're actually pretty optimistic on El Salvador for the medium and longer term. Costa Rica, on the other hand, spreads are also high, probably for very good reason. The fiscal reform they passed last year was, very positive if you look at it, but you have to remember that just stabilizes debt to GDP in a few years. It doesn't actually bring debt to GDP down, and that's only if they implement things 100%, which we've already seen some slippage in the news this year so far too. And then furthermore, interest costs are just ballooning in the country too. So I think the budget for next year has interest costs going up almost 20% on a year-over-year basis. Last year they ran into a big liquidity issue, so the government was forced to issue at pretty high rates just to fund the government, and those interest costs start adding up over time. So there's no short-term situation that's going to enormous concern in Costa Rica, but over the medium term, I think there's a lot more to do. And then furthermore, Costa Rica, everyone talks about El Salvador growth being pretty low, but Costa Rican growth is slowing pretty quickly. It gets revised down almost every few months, so there's not even a pickup there to help on the fiscal side of things too. So. Yeah, both spreads are pretty high, but I think, if you compare the two on a relative value basis, El Salvador seems a better place to be for the longer run.
Thank you, JD. So Patrick discussed mostly the risk factors, but also Costa Rica seems to be on track to reduce the fiscal deficit, stabilize debt. They have the 2020 budget has includes some cost-cutting measures. Do you think that these measures are sustainable, and do you think that they are enough to dispel the risk of turmoil and maybe another crisis?
Don't want to speak the book, but I would join Patrick on being probably negative on Costa Rica. So it's difficult to find, positive scenario. I think the fact that they capped the current expenditures at 4.7 is a good signal. And having a fiscal rule is always a strong signal. The biggest worries, like Patrick said, is the interest expenses. How much of GDP it costs? It's between 5 to 6% in terms of expenses to revenue. Interest expenses to revenue, you speak about 40%.
Right.
So if there is some fatigue, we know that a lot of the discussions when it came to capping the salaries were challenged in the court. So implementation is going to be key when it comes to Costa Rica. And when you look at the revenue side, the elasticity to GDP is quite high. So it was a quite positive fiscal law that they passed. And if GDP goes below 2%, then you're going to really feel some of the mandatory spending, including the interest, biting into the debt dynamic. And I think that's the big thing. If you look at the short-term debt, the crowding out to the private sector is massive, and they have to roll over that. And that starts biting into the dynamic because they have to pay up. So that's one of the key concerns we have in Costa Rica, with little positive.
Thank you. Yeah, probably we are going to hear more positive later today when Governor of the Central Bank, Rodrigo Cubero, speaks here. So, Marcelo, in general, you mentioned some of the external factors, and the region is highly dependent on the U.S., positive spillovers through the different channels. These factors will likely become less supportive next year. But on the other hand, monetary policy all over the world is becoming more accommodative, and that could provide opportunities for the region. We cover that in our capital flows report, actually. So how do you see these opposing forces playing out next year for the region?
Look, Martin, I think we have to disentangle between the near-term challenge for next year and the long-term challenge down the road. For the near-term challenge, usually economists talk about demand management policies, monetary and fiscal. And I think about the region, as for emerging markets more broadly, clearly there is room for further monetary policy. Rates have come down and probably come down further where possible. We've seen it globally that happening, right? The Fed is cutting rates already, will cut further, most likely. DCB is doing whatever it can. Bank of Japan likewise brought rates to zero. Long end of the curves are in negative territory, with spillovers, therefore, for emerging markets as well, including the region, that are cutting interest rates. So that's here and that's here to stay. On the fiscal front, though, I feel a bit more skeptical in terms of room in the region for any massive fiscal expansion, simply because the debt levels are just too high. So actually, if anything, you need to do some fiscal consolidation first to recover some fiscal room to then, and when possible, to use fiscal as really a lever, right, as a policy tool for the demand side expansion in the near term. So to answer your question, short run here, the medicine is most likely monetary policy, realistically, than fiscal easing. Long term, though, let me just say this. The key challenge is neither monetary or fiscal, is structural reform. We all know that's what leads to stronger growth sustainably over time. It's labor, capital, and total factor productivity. So labor is not just more workers, but it's better workers, which has to do with education. On capital productivity, it's all about infrastructure, which is a major challenge in the region, how you finance it. And then last but not least, total factor productivity, which is basically making sure you have a business environment which is conducive for the private sector to thrive and therefore bring growth on a sustainable basis to the economy.
Thank you. And you mentioned structural reforms, JD, in Jamaica. Jamaica is one of the bright spots in the region. I don't know if you agree with this.
That's the opposite of Costa Rica.
Yes. And the country, has maintained fiscal discipline. The monetary policy framework has improved significantly, but also is highly exposed to the oil price, remittances also, tourism flows. Debt is also at a very high level. The ALPAR downtime has been extended. The IMF program will be no longer there soon. So as an investor, how do you assess external vulnerability in this case?
So Marcelo mentioned a few key points, but I think the key in Jamaica is, first of all, the importance of experts. We have Alumina that was a massive driver behind the growth rebound that we have seen in 16, 17, 18 coming back. The key other sector is tourism. Declined also lately, and it goes to your point you said about the tie with the United States and how is the US doing in terms of sending tourists to the region. Overall, Jamaica has a structural growth issue because if you look at the growth, it's stuck between 1% and 2% for a decade. On the other side, they have been working strongly on reaching a primary fiscal surplus around 7%, which was good for the debt dynamic. We see, if you remember back to 2012, the debt dynamic has now gone below 100% and should keep declining. Vulnerabilities, or what we're going to look at, is the Standard Oil agreement is reaching its end in November. So will they stick to some kind of fiscal prudence? That's the biggest question we're going to look on our side. Still, again, they don't have that much room in terms of spending. Right. The fiscal jacket is quite stretched for most of those countries. So they have to really forge alliances and make sure that you have enough FDIs coming in the countries. And not only the FDI overall, but new FDIs, and not the investment of earnings that these companies have had in the region. So that's the key thing, and slippage on the fiscal is one of the key concerns we may have if we see the government starting to overspend, plus any case of natural disaster or weather that may affect the whole region.
Yeah, I have a question about that later for the whole region. Patrick, so moving into more sort of operational issues for investors, and Jamaica has made several improvements in terms of market infrastructure and electronic FX trading platforms and so on, but the Dominican Republic has also been one of the leaders on this front. And most investors focus more on the sovereign and maybe corporate credit when we look at the region, but local markets are increasingly important. And actually in the DR, local market is one of the deepest in the region. Participation from local pension funds and banks is significant, and also foreign investors. So how do you see access to this market?
Yeah, thanks, Martin. We've been investing in the DR local market probably for over a decade, and like you said, it is one of the deepest in the it is the deepest in the region. So that's a fact, and I think people are surprised that it is as liquid as it is. Nothing compared to other EM countries, but I think you can actually build a decent sized position without too much trouble over a couple months. When you look at the DR, yields for a long time have offered bonds have offered yields from 8 to 10%. There's basically a currency policy by the central bank where the currency depreciates 3, 4, 5, 6% a year. So your all-in return is not going to be anything massive, but it's actually been pretty stable, so pretty high Sharpe ratio over the long run too, not just in the last year or two. We think for the long run, actually, it's a great story, and yields have been high basically because nominal growth has been pretty high, and also because there's been this crowding out factor where the central bank needs to be recapitalized, so it actually issues a ton of bonds as well. So it issues and competes with the government. So there's actually been a recap bill, for a long time, but it seems like it's moving ahead. And if the central bank ever does get recapped, they will no longer be in the market, and then it will just be Hacienda issuing bonds. And we think that can actually bring rates structurally down for the longer term. But operationally, it's actually more straightforward than people think to enter the market. And foreigners, depending how you measure, are anywhere from 10 to 25% of the market. So it's not like it is completely off everyone's radar for now.
Thanks. JD, you have also positions there. You share this view?
I think two things worth mentioning. We are mainly a credit house, so we buy only dollar-denominated debt. I think the inclusion of Dominican Republic into some of the ETF indices has helped a lot. That has also compressed a lot the local yield. So the moment that you have the passive flow going into a country, the inclusion into an index like the JP Morgan, GBI, EM Global Bond Index, you're forcing flows into your country, and then as a result, you see yields falling in parallel.
Alina, so in terms of domestic financing in El Salvador, a key instrument is the short-term debt, the LETES. that has been, a long-standing instrument. Rollover and costs have been also some of the issues. The stock has remained below the 30% of revenue threshold. And the finance minister has expressed intentions in the past to actually reduce dependence on this instrument. But what kind of measures could be taken to deepen this market? And actually, do you think there's a scope to broaden access to foreign investors to this market?
Yeah, so yes, he has shown interest. So because of that, when we were there in March and we started discussing what is the best technical assistance that we can offer and what other IFIs can offer, so we started a series of technical assistance missions. The first one was already in September to develop a medium-term public debt strategy framework and to do a diagnostic in terms of the elements to how to develop the domestic debt market. So we will see now when the next mission is going to come in to help them do that, exactly that. Otherwise, for foreigners, as of now, yes, they can enter through the Eurobond a lot more than they can enter through the letters. Through the letters, they can try to buy through Citibank, but I think it's going to change. So he's looking to change that. Yes, he's looking to deepen the market.
Thanks. Juan Pablo, what's your view on this?
Well, I think, first of all, that this new administration has so far been implementing a strategy of reducing the amount of lattice auctions. So it has led to a reduction in yields. So the market, in a sense, is in a sweet spot, and I think that investors are at the same time with very high expectations on the government. So there seems to be a very short-term important momentum in the market, but going forward and thinking about developing a much deeper market, I think it is not only a matter of supply, meaning of the government doing a credible and sound issuance program, but also a matter of demand, and especially developing institutional investors in El Salvador. We at Grupo Bancolombia have been leaders in creating money market mutual funds. It has been so far a hard task because you need to face many barriers, not only in the market and with final clients, but also with regulation. But we already have a fund in the market, and our expectation is that those type of products, very straightforward, can really lead people to invest more, and in that way to have more players in addition to pension funds. So I think that the financial industry needs to be very, very active in trying to pursue and to establish those type of initiatives.
Patrick, any comment on that?
No, I mean, I think those are all worthwhile initiatives, and I think the demand will be there. I mean, especially even from foreigners as well. I mean, you look at the local lettes market. It's investable. It's not easy, but it's investable, and sometimes the pickup over the similar maturity external bonds can be anywhere 300-400 basis points. The similar story exists in Costa Rica too, where you can have similar pickup in local law dollar bonds, and I think the Costa Ricans have done a good job developing their local dollar market too. So it's not something that's impossible, and I think the end demand would be there in the end.
Thanks. Marcelo, region-wide external financing needs are large, still high current account deficits, and also debt repayment. Financial dollarization in the region is also significant in many countries. And when you look at buffers, external liquidity buffers, and those countries need to have more buffers. Also, the fact that the risk of weather-related shocks is also important in the region. Many countries have loans from the IDB to mitigate this risk. Also, items in the budget. But what's your assessment of external liquidity, foreign reserves in particular?
I think you're right, Martin. I think the buffers on the external side are fairly low. And you look at when you look at the reserves, for instance, the IMF has metrics for this. I remember working for IMF for a few years. I remember the numbers. You look at things like, okay, how many months of imports you have, or how many months in terms of debt payments you have in terms of reserves. When you look at that kind of metric, the region doesn't look particularly good. I mean, our reserves as a share of GDP in the region range from 10 to 20%, roughly speaking, which is relatively low. But I would highlight that even though the stock is relevant, perhaps equally relevant, if not even more, is the flow. I mean, how you finance your current account deficit is equally important, because after all, reserves are finite. They can look large, but if you just draw down on them, you end up with nothing at the end of the day. So the recurring flow of external financing matters, perhaps even more, and also the composition of external financing, especially FDI.
Mm-hmm.
And I think that's the key, I think, for the region. Even more importantly, therefore, than reserves, is to make sure that we have the conditions in place in the region to attract sufficiently FDI. When you look at FDI into the region, it's relevant, but certainly can be higher. For places like Panama, Costa Rica, it's mainly from Brazil, Mexico, but certainly you can attract other countries if you have the right conditions in place. So reserves matter, but even more importantly, I would argue, is attracting FDI.
Thank you, Marcelo. And Alina, in El Salvador, actually El Salvador is one of the countries where FDI is falling short, non-resident FDI is falling short in terms of financing the current account deficit. What's your view on that, on external accounts in general, maybe?
El Salvador has a large diaspora population, so for them remittances are very important. So as long as their remittances flows and even growth of those flows remain, the current account will widen, but just a little bit. And the FDI, in terms of the FDI, again, the president is trying to attract FDI, so we will see how much he will be able to attract.
Thanks. Thank you very much. JD, any comments on that?
I think what Marcelo said on the difference between FDIs and remittances is a hot topic, and it has to be monitored closely. I think if you look at both Panama and Costa Rica, remittances to GDP is below 1%, whereas in Jamaica and Dominican Republic it's double digit. You know, Jamaica is close to 14 to 15, and DomRep is probably, you know, high single, 7 to 9, something like this. So that's a key point. But back to the structural question we were discussing about the potential growth and the productive factor you were mentioning, Marcelo, is the big question, is the quality of the FDIs. And will they come for what purposes? And that's the biggest concern we may have.
Thank you. We have several questions from the audience. We have some time, so for maybe one or two. Here is the first one. What about Nicaragua's political and economic situation? How can trade and investment be affected within the region? Any takers? Juan Pablo?
Well, I think that what the neighbor countries to Nicaragua has been trying to do recently is trying to bypass the country on the basis that problems are structural in both economic and political terms, and that a quick solution is not feasible. So the solution has been to try to create ways to promote trade across the region by bypassing the country. So I think that's unfortunate, because one of the keys for Central America future is integration, because I think that there's a potential for closer trade and financial ties, and with time maybe Nicaragua, if there's a regime change in the country, can be also part of that community.
Any other comments on that? And another question, maybe if we can answer briefly. The region is highly dependent on the oil price. What is the oil price outlook, and what would be the implications of higher oil prices in countries in the region? So I think it's very broad, but maybe a quick comment on that.
So as a house, we're quite negative on the oil price due to the supply. And if you have a global slowdown, as a result, oil might also come down further. But also you also have the rise of green energies and renewable. That may also change the balance. I think with lower oil prices, as most of the countries are net importers, it's going to be beneficiary for them and have a positive impact on inflation.
I'll just say that the outlook for oil prices, as for commodity prices in general, depend mostly on two main factors, which is global growth and the dollar. Global growth is coming down, particularly in China, where we think Chinese growth will be less than 6% already this year and next. That's not good news for commodity prices in general, for oil in particular. And the dollar has been strong. So if the dollar does remain strong, as it's possible, it's not good news for commodity prices either. So all things told, we do see oil prices, if anything, probably heading lower rather than higher. Although, of course, we have spikes related to Middle Eastern conflicts and so on. But we think, to give you a number, the Brent oil prices that we think average 62 this year, dollars per barrel, probably come down to around 54 next year.
Thank you. So we ran out of time. Thank you very much for the interesting discussion, and please join me in thanking the panel with a big round of applause. Thanks.